Welcome to Blockchain Vein, the home for AI, hacking, blockchain, crypto trading, and technology. Please like and subscribe. In a landmark decision, the world of cryptocurrency and traditional finance have collided with the introduction of the first Bitcoin ETF. But what does this mean for investors and the future of Bitcoin? Let's dive in. An exchange-traded fund, or ETF, is a type of investment fund and exchange-traded product traded on stock exchanges. ETFs are similar in many ways to mutual funds, but are traded on the stock exchange during the trading day just like shares of stock. Unlike mutual funds, however, ETFs can be bought and sold throughout the trading day like stocks. Now imagine this concept applied to Bitcoin, the world's first and most popular cryptocurrency. This introduces a Bitcoin ETF, which essentially tracks the price of Bitcoin, allowing investors to buy into the ETF without actually having to buy the cryptocurrency itself. This development marks a significant moment for Bitcoin, bringing it further into the mainstream investment world. Bitcoin, the first and most well-known cryptocurrency, has had a volatile journey since its inception in 2009. Created by an anonymous person or group known as Satoshi Nakamoto, Bitcoin offered a new digital form of currency powered by a technological innovation called blockchain. Throughout its early years, Bitcoin remained a niche interest for tech enthusiasts and was often associated with illicit activities due to its anonymous nature. But everything changed in 2017 when Bitcoin hit a then record high of nearly $20,000, pushing it into the mainstream spotlight. Since then, Bitcoin has experienced periods of explosive growth followed by significant drops, exhibiting a level of volatility that is both a draw and a concern for investors. Amidst all this, Bitcoin's underlying technology, blockchain, has gained recognition for its potential far beyond digital currencies. Its path has been marked by sharp rises, dramatic falls, and intense speculation. Unlike purchasing Bitcoin directly, an ETF allows investors to buy shares that represent the digital currency without dealing with the complexities of crypto wallets and exchanges. Now, let's delve a little deeper into what this means. You see, a Bitcoin ETF, or exchange-traded fund, is designed to track the price of Bitcoin, but instead of buying Bitcoin itself, you're buying shares in the ETF. Think of it as a bridge between the traditional world of investing and the relatively new territory of cryptocurrencies. So, how do Bitcoin ETFs work exactly? Well, the fund purchases a certain amount of Bitcoin and then divides ownership of those Bitcoins into shares. As an investor, when you purchase a share of a Bitcoin ETF, you effectively own a piece of the fund's Bitcoin holdings. But you don't need to worry about setting up a digital wallet, finding a Bitcoin exchange, or dealing with the technical aspects of owning cryptocurrency directly. What's more, Bitcoin ETFs bring with them the regulatory oversight of the traditional financial world. They're subject to the same rules and regulations as other ETFs, which can provide a layer of security and assurance for investors who may be wary about the often wild West-like nature of the cryptocurrency market. But perhaps the most significant advantage of Bitcoin ETFs is their accessibility. They're traded on traditional stock exchanges, meaning you can buy and sell shares in a Bitcoin ETF just like you would shares in a company. This opens the door to a much wider pool of potential investors, from individuals looking to dip their toes into the world of cryptocurrencies to large institutional investors seeking exposure to Bitcoin as part of a diversified portfolio. To sum things up, Bitcoin ETFs offer a simpler, more accessible way to invest in Bitcoin, without the need to navigate the intricacies of the cryptocurrency world. This ease of access could lead to more widespread adoption of Bitcoin investment among traditional investors. The introduction of the Bitcoin ETF is expected to have significant implications for the market. Let's delve deeper into this and understand what these implications might be. The launch of the Bitcoin ETF could stimulate an influx of liquidity into the Bitcoin market. This is because ETFs, being easily tradable on traditional exchanges, offer a simple way for institutional investors to gain exposure to Bitcoin without the need to navigate the often complex world of cryptocurrency trading platforms. This increased liquidity could, in turn, lead to enhanced price stability for Bitcoin, reducing the extreme price swings that have characterized the cryptocurrency's history. On the flip side, this could also mean that the price of Bitcoin may start to reflect more closely the behavior of traditional markets. ETFs are a staple of mainstream finance, and their movements are often influenced by broader market trends. For instance, if stock markets tumble, this could create a knock-on effect and drag down the value of the Bitcoin ETF, and in turn, the price of Bitcoin itself. Moreover, the Bitcoin ETF could potentially increase the correlation between Bitcoin and other assets. Traditionally, Bitcoin has been viewed as a non-correlated asset, meaning its price movements do not typically align with those of other asset classes. This has made it an attractive option for investors seeking to diversify their portfolios. However, with the advent of the Bitcoin ETF, this could change. Finally, the Bitcoin ETF could also lead to greater market transparency. ETFs are subject to stringent regulatory oversight, which could help reduce instances of market manipulation and fraud in the Bitcoin market, thereby increasing investor confidence in this new asset class. In conclusion, the introduction of the Bitcoin ETF is a significant development that could bring about increased liquidity, potential stability in Bitcoin's price, and closer ties to traditional markets. However, it also means that Bitcoin's value could become more closely tied to the behavior of traditional markets. Different countries have varied responses to Bitcoin ETFs, each shaping the market in unique ways. The global landscape is a mosaic of diverse regulatory approaches. Some nations have embraced the concept of Bitcoin ETFs, seeing them as a way to bring legitimacy and stability to the often volatile world of cryptocurrencies. They believe that by integrating Bitcoin into traditional financial systems, they can better control and monitor its use, reducing the risk of illegal activities. Other countries, however, have taken a more cautious approach. Concerned about potential risks associated with cryptocurrencies, including fraud, money laundering, and destabilization of traditional financial systems, they have either restricted or outright banned the use of Bitcoin ETFs. This global divergence in regulatory approach is creating a fascinating dynamic within the international financial system. For instance, in Canada, the first North American Bitcoin ETF launched in February 2024, showing how global financial regulations impact cryptocurrency. Bitcoin ETFs represent a fusion of traditional finance and emerging blockchain technology. This amalgamation is not just a testament to the adaptability and versatility of our financial systems, but also a reflection of how technology is continually reshaping the landscape of investment possibilities. Blockchain technology, the backbone of Bitcoin, has revolutionized the way we think about financial transactions by offering a decentralized, secure, and efficient platform. With the birth of Bitcoin ETFs, this revolutionary technology has found a new avenue to influence traditional finance. By tracking the value of Bitcoin, the ETFs are capitalizing on the benefits of blockchain's transparency and security, while offering a level of familiarity and accessibility for traditional investors. This is a prime example of how innovative technology and classic finance can merge to create a product that could potentially change the investment game. Recent technological advancements related to Bitcoin ETFs highlight how technology is driving financial products, creating new opportunities, and paving the way for a more versatile financial future. Experts predict a surge in the popularity of Bitcoin ETFs, indicating a potential shift in digital currencies' integration into broader financial markets. As Bitcoin ETFs bridge the gap between the volatile world of cryptocurrencies and the more predictable realm of traditional finance, the landscape of investment is set to be transformed. The introduction of Bitcoin ETFs is seen by many as a bullish signal for Bitcoin. This development could potentially drive increased liquidity in the cryptocurrency market and, by extension, more stability in Bitcoin's price. In the short term, we might see a rush of new investors, drawn by the allure of a burgeoning market and the relative safety of a familiar investment vehicle. In the long run, however, the impact of Bitcoin ETFs could be even more profound. As they gain traction, these funds could become a standard part of many investment portfolios, much like stocks, bonds, and commodities are today. This could lead to a broader acceptance of Bitcoin as a legitimate asset class, and by extension, a greater acceptance of cryptocurrencies in general. But what of the risks? Critics warn that the rise of Bitcoin ETFs could also mean the amplification of Bitcoin's notorious volatility in the traditional markets. The world of cryptocurrency is still largely unregulated, and the introduction of Bitcoin into mainstream finance could bring with it a host of unforeseen challenges. Yet the future of Bitcoin ETFs is not written in stone. The evolving regulatory landscape, technological advancements, and market dynamics will all play a role in shaping their trajectory. Some experts even foresee a future where multiple cryptocurrency ETFs exist, each tracking different digital assets. In conclusion, as we look to the future, one thing is clear. The rise of Bitcoin ETFs signifies a potential paradigm shift in finance, one where traditional and digital currencies coexist and interact in ways we're just beginning to understand. These predictions suggest that we may be on the cusp of a new era in financial technology.